This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL Covevel. Not filtered, raw, honest. That's my passion. One of my favorite criticisms of trend following trading, especially in the media, which really doesn't know what the hell they're talking about, is the phrase black box. 9 times out of 10, when you hear trend following trading discussed, the word black box is used, and as a pejorative, as if somehow or another there's this magical computer that's doing all these wonderful things, these mysterious things, secret things, no humans involved. And somehow or another, that makes it more risky. That's what the term black box is used for, to marginalize those that are successful with trend following trading. It's probably also to protect all those financial news shows, buy and hold mutual funds, to protect their books, so to speak. Because if they have to acknowledge, if they have to admit that the efficient market hypothesis is wrong, if they have to admit that models or systems are a hell of a lot more valuable and useful to the average investor, well, they won't be getting that big paycheck anymore, will they? Today, I have a few clips that I want to play. The first clip, actually both clips, are from Jim Simons, the chairman of Renaissance Technologies, who generated for himself around $14 billion. I think it makes him one of the 100 richest people in the world, all from trading, all from models. This first clip, let me let Jim explain his view on the efficient market hypothesis.
There's something called the efficient market theory, which says that there's nothing in the data, let's say price data, which will indicate anything about the future, because the price is sort of always right. The price is always right in some sense. But that's just not true. So there are anomalies in the data, even in the price history data. For one thing, commodities especially used to trend, not dramatically trend, but trend. So if you could get the trend right, you'd bet on the trend, and you'd make money more often than you wouldn't, whether it was going down or going up. That was an anomaly in the data, but gradually we found more and more and more and more anomalies. None of them is so overwhelming that you're going to clean up on a particular anomaly, because if they were, other people would have seen them. So they have to be subtle things. And you put together a collection of these subtle anomalies, and you begin to get something that will predict pretty well.
So who do you believe? The professors at the ivory towers? Or the guy using models to trade, that found anomalies, that knows the markets are not efficient? Who do you believe? That's a choice that you have to make. I can't make it for you. No sales pitch from me, no sales pitch from anybody else. But you, as a thinking, rational human being, if you happen to be rational, you have to ponder for yourself. And don't just believe Jim Simons, even though there's some smart reasons to believe him. Take his words at face value. Go justify. Figure out what he means, why he is saying that. The second clip talks about models, also from Jim Simons.
This is 100% model-driven. It's not 90% or 80%. Some people have models, and for advice. They say, what does the model say? Oh, yeah, let's go. Oh, I don't forget that. I don't want to pay attention to that. So, Renaissance is 100% model-driven. No trade is ever made because someone walks into the trading room and says, hey, let's buy IBM. It's a sure winner, or anything like that. We got too much Google. We got to show it. Nobody does that. It may be that we had too much Google, but nonetheless, he might have been right. But it's just what the model says. And that religious sticking to the model is the only way you can run such a business, because you cannot simulate that guy who walked in and said, hey, Google's too high, let's sell it. How can you simulate that? You don't know what might have happened. But you can you can come up with a model or a new predictor, and you can simulate it in the past and see, how did it do? So you have to stick to it.
I know you guys made the model, so you do have the ownership of it and feel proud of it. But is it hard to follow the model religiously? Like, is it hard for your ego to think all the success is because of the computer? Like, and I just sat there and watched? No,
the computer's just a tool that we use to, I mean, it's a good cabinet maker doesn't say it's all because of my wonderful chisel. You know, you may have great film equipment, but that's not why you're a success at doing what you're doing. You're working with good equipment, but another guy would make a mess of it with the same equipment. So, no, we don't feel, the computer is doing everything. The computer does what you tell it to do.
I love that. Absolutely love that. He completely takes the black box pejorative, turns it around on the reporter, and makes the reporter look stupid. Makes the reporter look absolutely brain dead, not thinking. But then again, maybe the reporter is not stupid. Maybe he doesn't understand that the computer is just a tool. Human beings program the computer. Human beings put the rules into the computer. It's simply a way to make life easier. It's a way to do more. It's a way to leverage your time. The computer is not thinking. The individual is thinking, and the individual programs the computer with the trend-following rules. That's the way it works. One other point about Jim Simons. Very secretive. If you ever hear him talking about his trading strategies, he basically doesn't. He says, we don't use fundamental analysis. I used to a long time ago. It didn't work. We use models now, and that's about it. From there, you have to draw your own conclusions. Very secretive firm. No one leaves. No one talks. But you can bet your bottom dollar that for a firm that trades 100% models, I can't sit here and tell you that Jim Simons' firm, Renaissance Technologies, is 100% a trend-following trader. I can't do that. But there is absolutely no way that a 100% model shop does not have a significant portion of their trading strategies in trend-following methods. That you can rest assured of. The second part of this presentation today is an interview. Actually, I was interviewed. These are some of the highlights from a recent interview where Andrew Horowitz interviewed me for his show. I hope you enjoy.
I think I first maybe heard about you, or maybe at least my recollection was that I can relate the name of or the phrase turtle trader to you. I guess the first question is, what's a turtle trader?
It's just the greatest story when it comes to learning a trading technique from somebody else that exists in Wall Street history, at least in my humble opinion. And a very wealthy guy named Rich Dennis, who had made his first $1 million in the mid-1970s trading on the floors in Chicago. And then by the early 1980s, he had made a couple $100 million, was probably the biggest, baddest trader on the planet. And him and his partner, Bill Eckhart, they went to see the old Eddie Murphy, Dan Aykroyd Trading Places movie. They walked out. His partner said, wow, what a great movie. The story takes someone off the street, make him rich and famous, yada, yada, yada. And Rich said, well, we can do that. And his partners was like, hold on, how are we going to do that? They made a little bet. They put ads in the paper. They asked for trader trainees to respond. About thousands of people responded. They hired approximately 20 people. And over the course of right around 4 years, the group of 20 approximately made about $100 million profit. They were taught trend following techniques, and they really gave a lot of weight to the idea of nurture and nature and that debate. And so nurture won in that case.
Wow. So this whole idea of taking guess the bigger picture we can look at is taking anybody who at least has the desire, the to be involved in this, and teaching them certain techniques, strategies, rules, disciplines can really help them make money in trading the markets. Now, has that changed over the years?
I don't think it's changed, but I think you started to bring something up, which I think is true. If you put trading aside for a second and just talk about any life success, I mean, the vast majority of people aren't going to do it. They're just not going to do it. They're going to hang out on their iPhone. They're going to watch cable news. They're going to talk a mean game, but they're not going to do it. So I don't care what the life success is. I'm sure the old 80-20 thing is following and right on down the line. So I think that's terribly important. So of course, so if that's the case, can anybody learn? Yes. Does everybody really want to do it? Probably not.
Mm-hmm. Well, it's like a diet.
Yeah.
I mean, it's like a diet. You know what you have to do. You know what you have to eat, what you don't have to eat. You know what's going to be bad for you. And all right, listen, you could cheat a little while, which would be the equivalent of, okay, for a few hours hanging out on the iPhone, not paying attention to what you're doing. But, you got to get back right on the saddle again. And the fact is that it's all about, it comes back all to the desire, the discipline, and all that. And I guess that's why computers these days are so good at it. If you can teach a computer and design a computer to have an algorithm that can follow a particular set of features that will actually do something, they're not going to take a break.
Yeah, I was watching a video the other day. Jim Simons, Renaissance Technologies. People have probably never heard of him, but he's one of the richest guys in the world. He's made $14 billion for himself, all trading models. And he was asked by a reporter. He said, "Hey, do you kind of feel bad, or watching the computer do all the work, and you're not doing anything, and you just sit back and watch? Does that feel good for your ego?" And he said, "What are you talking about? No." And I'm paraphrasing here. He said, "Look, if you give is the chisel the responsibility for making the carpenter good? No, it's just a tool. And a computer's just a great tool to get all of the human biases out of the equations, the reasons why Daniel Kahneman won his Nobel Prize. The computer helps to fight human nature."
Right. So now you mentioned trend following. This is something that you teach, something you wrote a book about, something that's all a part of this. Can you give us, from the very basic, I know nothing. I'm pre-turtle, egg. What is trend following?
It starts with the idea that none of us can predict tomorrow. So if you can't predict tomorrow, and you have a sneaky suspicion that fundamental analysis doesn't exactly do what people think it does, regardless of how many successful stories are popped out, like a Warren Buffett, and I salute Warren Buffett. He's made a fortune, but there's only one. And so trend following is about saying, okay, if all the fundamentals and all this news and all this noise isn't really useful to making money, what can we use to make money? Well, you can look at the markets themselves. You can look at the price action. You can look at the movement of the price. For example, look at crude oil in 2014. Basically drops 50%. Nobody was predicting that, right? But if you had a trend following system that was going short on something simple like a moving average or a breakout, you took that short position. You don't know anything about OPEC. You don't know anything about what's going on in global macroeconomic whatever, but you're just short. And at the end of the year, you wake up and that market's gone down 50%. And that particular market would have carried you through. So the idea is not unlike people have seen the blackjack videos and stuff. I mean, like, for example, the MIT blackjack team. This is all about finding an edge. So if you're going to just trade trends, if you're going to say, I don't know anything. If the market's going up, I want to be long. If the market's going down, I want to be short. And I'm going to have a simple signal that gets me in. I'm going to have somewhat complicated money management because we've all got limited capital. So if you've got limited capital, how much are you going to bet on each trade? And run that through, you're going to end up with 30, 40% winners. And your winners are going to be 3 to 4 times the size of your losers. And you're simply trying to find a small edge that you can bet on. Because if you've got a small edge that you can bet on, you can win in the long run. It's the exact polar opposite of anything and everything that's ever talked about on any financial news channel ever.
Well, the problem is there's nothing to talk about, really. If you think about it, at the end of the day, it's so simple. It can't be so simple that how much time would it take up on a financial news channel? So therefore, you have to stuff it with all the reasons. Now, I think one of the big things here, and I think you'll probably agree with this, is that the reason that there is all the news, the reason that there's such an attraction to that is that we all need to know the reason why. We're all in search for rationale. Why is oil going down? It doesn't matter that it's going down. Why is it going down? And then we can kind of at least say, okay, I understand that, and therefore I can then trade it in this direction, in this bias, because we don't want to do things oftentimes just simply by following a trend. And I'm speaking generally here. So what happens is that individuals will look for all these reasons, all these ideas, and come up with something. For example, you look at a stock that, again, I'm talking fundamentals for a second, that is undervalued. Well, there's a reason why it's undervalued, and it's starting to move lower and it's lower, and it continues to say quote unquote undervalued fundamentally. And all these guys say, well, it should start moving higher because of this, and there's a catalyst that's doing that and all this. But meanwhile, if you were to follow that and you start buying it and it's still moving down, now you're not following the trend. What you're following is the hopeful idea that it will turn, which it may one day, by the way. But the fact is, maybe that trend isn't exhausted yet.
Yeah, the why part is interesting because at some stage of the game, I think we have to all be a little bit honest with ourselves and say this desperate desire to have the why. I mean, are we at the point in time in 2015 we can say that's delusional? And so then if you bring up the financial news shows, I can say quite simply why they exist. They sell advertising. And the people that come on their shows are selling a book of some sort, a financial book. I mean, their book of money management firm, et cetera, et cetera. And look, we all sell something. We all sell something. I'm selling something. You sell something. We all sell something. The question is it an honest sell? That's the real thing that drives me.
Well, the thing that's funny is that, I don't know if you've noticed this, because, I keep news. I look at news. I look at just various things during the day, just kind of feel what's happening, stay in touch with what's happening, of course. And I find that when I start looking at whether, it doesn't matter the station, but everybody's saying the same thing, which may not be associated to what is actually happening, but everybody is, I guess at this point, so worried about being wrong that everybody is consensus on everything. There's so few outliers.
That's another issue too when you talk about, if you're talking about the professional money management world, there's a lot of career risk. I mean, folks are paid a lot of money to look like their neighbor. And so if they don't look like their neighbor, I mean, they're not even attempting to do the right thing for their client's money. They're just attempting to keep their job. And keeping their job is if my other neighbor fund manager is down 10%, well, if I only go down 9 or 10%, then I'm okay. And I'm looking at it saying, hold on, you're both down 10%. You're both bad.
Yep. No, I agree. It's kind of interesting that, taking that risk of being out of the market, forget about being short for a second, but being out of the market is almost like it's heresy, and it's absolute. It is the polar opposite of job security. But do you now, one of the things I always tell people, or I think to myself too, is, sometimes, hey, just turn a chart upside down, back and forth, and then don't even look at the numbers and which way would you go? This way you turn off the whole short-long concept in terms of bias.
Yeah, well, I wouldn't even look at a chart. Why do you need a chart? I mean, think about it. If you were on a desert island and all you had was price quotes coming across some old-fashioned ticker tape, and you didn't even know the names of those markets, but you just had, you had 30 series of quotes coming in every day, and all you had was a closing signal. At some stage of the game and your infinite boredom sitting on that island, could you find a pattern? I mean, this goes square against the efficient market hypothesis orthodoxy. I mean, this is everything against the University of Chicago. I mean, anyone that's still talking about the markets being efficient, they're just drinking Kool-Aid. Yeah. So, can you find that pattern that you can bet on? Is there a small edge that you can bet on? And then once you've got that edge that you can bet on, almost rooted in the old Kelly criteria theorem, what's the optimal bet that you can make?
So if you don't use charts, now you say you don't use charts, or you're just not,
what are they for?
I don't know. You define the particular trend to see visually, just to visually see the trend. No?
Okay, but you're making your judgment, you're making your signal, you're taking your entry or your exit off something very straightforward, like a moving average or a breakout. So if you're trading off that, then the chart is just there to fool you in some ways.
So talking about a breakout, because I'm a little bit confused. Talking about a breakout, how do you know what the breakout is if you don't have a chart to look at the pricing where the breakout happens?
Well, if you just got a series of prices, if you just got a vertical column in Excel, and you're saying, okay, what's the highest high of the last 200 closing day prices? And now I've just hit that. And so the market, whatever market it might be, it doesn't really make a difference because we don't need to even know the names of these markets. If anybody out there thinks that sounds entirely crazy, it's not. It's absolutely just a brilliant piece of trading strategy that was developed. Gosh, people argue it's been developed back to a guy named David Ricardo in the 1700s. Jesse Livermore doing versions of it. Richard Donchian putting the first trend following fund out in the 1950s. It's just something, if you haven't heard of it, you just haven't heard of it, but that doesn't make it not viable.
Now, a couple of other just follow-up questions on this. Over the last several years with the zero interest rate environment, and this may or may not be, this may just be kind of like, well, no, obviously we're not even paying attention. But with the changes in central bank activity and the change in liquidity of markets, has that changed anything at all in terms of the difficulty in finding profitable trades at all?
Well, 2014 was a banner year. 2008 was a banner year. And there was probably mixed years in between. But those banner years, 2008, 2014, there was many professional trend following traders that posted, 100% returns. I mean, so yeah, there's going to be choppy periods. You're not going to always have what you want, so to speak. And there's no doubt about it that trend following returns, given that most trend following traders produced double digit returns in October of 2008. And so there's no doubt about it that when the government decided that we were going to take actions to benefit certain groups in early 2009, that wasn't the best move for trend following traders. But then again, you can't control that. Yeah,
well, actually, it's interesting. It's interesting. If I may interject, it's interesting you mentioned that because in theory, obviously, just this makes sense though, but with trend following, you need to have a trend that is longer than 5 minutes, in terms of it has to have a little bit of gusto with. And that's why I can imagine that back in some of those years that you saw that there was a trend that followed through, that was a continuum. Obviously that wasn't just a chop, if you will, like a false breakout or a false breakdown. Obviously those are where the trend following doesn't necessarily work depending on your time period, right? Depending on the time frame. But I could see that clearly when there are those trends, and that's where probably, for example, in some of those years that we just saw that a couple times, chop just back to zero, chop back to zero, chop back to zero. That's not you can make money there, but that's not going to be a banner situation, right?
Heavy central bank intervention I'll argue, is not good for anybody. It's definitely not good for trend following traders typically.
Right.
And I don't know how heavy central bank intervention is great for just the average guy with a buy and hold portfolio, because as we've seen in the last 15 years, that usually sets people up for a fall.
Yeah, I also, obviously if, I remember back in 2008 where, or 2000, let's go before that, 2006, 2007, we got back to, buy and hold's the only way. And then everybody got spooked out and trading, and in and out, going long, short, whatever it was a much better play. And buy and hold guys were kind of like, picking up their wares and kind of with their heads down and going, oh man, is it going to come back? And then obviously we look back where we've seen such a rise over the last number of years with a couple of little valleys in there, but a continuation of just, buy the dip. Any dip is good to buy, and whatever reason is going to be in terms of just looking straight at the values of equity indices, different when it comes to commodities, that by, the guys back on the mutual fund wagon, ETFs, buy and hold, absolutely nothing else in between, are like, oh, see, we told you, if you just hung on, you would have been fine. And and I agree with you, it puts a level of complacency into investors that, they kind of forget about what happened. I mean, investors have a very short term, the average investor, a very short term memory for a lot of things, that may be a year, let's say. And when they get back, they're like, well, okay, well, don't worry about it. We're never going to go short. We're never going to sell again.
Yeah, I mean, I just think it's unusual that I guess it's not unusual, but when you have these 5 or 6 year periods where everything goes well in equities, and we all know that a certain amount of what's going on in equities is central bank rigging, is the nicest way to say it, then at some point in time, things have to revert. And we've seen the reversion twice in the last 15 years. And I just think people aren't prepared for it again. And for the life of me, if someone's not imagining, if you're just a buy and hold investor right now, I'm not trying to scare you, but you should be prepared for another 50% decrease at some point in time in the future. It surely will happen. I can't tell you when. I can't make a prediction. Nobody can make a prediction. But if you're not prepared for that worst case scenario, if you're not thinking that through, you surely don't want to wake up in retirement years and just saying to yourself, well, gosh, I just trusted the Fed and they were going to take care of me. And then one day they don't take care of you.
I guess what happens is that it becomes a more and more difficult concept the longer things go in a particular direction, to stay agnostic on the short long. That's the point, right? So what happens is that you get this feeling that, well, you know what? I'm not going to go short ever again. Again, not your average person that's trained, disciplined, and all that. I'm talking about the your retail trader or your mutual fund holder that is absolute. They're like, well, you know what? I'm just not going to do it.
But a trend following portfolio is not going to be just about, let's say, one particular index or one particular market and taking a short. It's going to be about having a strategy where you say, I will take whatever comes in terms of signals. Okay, I get a long signal, a long breakout, or I get a short breakout or a moving average that goes for the downside. I'm taking that, and I'm not, and there's got to be diversification there, because you're right. If you find yourself in a situation where you're literally having a battle within yourself about whether you're going to be long or short the S&P or something like that, just one, that's the only thing on your screen. Well, gosh, get rid of all the stress, buy Buffett, just go long, and don't do anything. Just you drive yourself crazy doing that.
Yeah, just go play golf.
Yeah. I mean, just take what instead of having this philosophical debate like we're having about whether the Fed is good or bad or this or that and what happens in all these alternate strategies. If you don't want any stress, just go play golf. You know that you're going to get some 50% clips if you're a buy and hold trader, and know in the long term that even though things might look really exciting in the moment, and my gosh, I look at what's going on in China right now. Everyone thinks they're going to get super rich. Everyone just, you can see the 1999 parallel for America. And, if you know in the long run, it's not going to work out that way. And the law of averages are going to bring all those massive equity gains on paper back down while you're playing golf. Yeah, it's a choice. It's a choice. Yeah. It's a way to live.
And my point of bringing this up is not, and just this is a very good point, I think, not to debate whether or not it's good or bad what the Fed did and how it will play out, but the concept of understanding that what the Fed is doing is what the Fed is doing, what the markets, and when I say the markets, I'm talking about all the markets, whether it's ags, whether it's equity indices, bond indices, it doesn't matter. They're doing what they're doing, and to try to disassociate the fact of what the Fed is doing today, or what you think they're going to do tomorrow, or what they say they're going to do tomorrow, by the way, and look at the bigger picture. Okay, what is happening, to bring it back to the concept? Because I believe in the idea of using, I call it technicals, but trend following concepts as a part of your buy-sell disciplines. I think it's very wise, and I think that we want to bring it back and make sure people understand that as a core part of what they're doing, and don't get wrapped up in all this. But the point is that, discussing all the Fed and discussing this again is still, even that we are discussing it, at the end of the day, you're going to go back and say, that's great. It was a great discussion.
Yeah.
But
you got to have a plan. You got to have regardless of what happens, you have to have a plan. And even for those individuals out there that are saying, oh, I like this guy, Mike, he's talking about how bad the Fed is and da-da-da-da-da, and that means I'm going to buy gold now. That's just as bad. That's not a plan either. That's not a plan. It's you can't go. The end timers thing is not a plan. So it's almost like you need to draw that map, that schematic out on your desk, and say, what are the valid strategies out there that I can employ? How much time will they take me to execute? What do I want over the course of a lifetime? And then that's it.
Yeah. And by the way, the other thing, and I think this is an add-on to what you just said, is that if you had a predisposition to gold and you were thinking that, gold is going to go up eventually. I like what that guy Michael said. He confirmed my thoughts on gold. I'm going to buy gold.
Right. And I didn't say that, but you know what? Some people will probably think they heard that.
Right, exactly. So the thing is, be careful of your predispositions for something, which is again the same is the polar opposite of what we're talking about here, which is clear the deck on a regular basis. Have a sign up in your office. Today is a new day, and today may or may not be a new trend, and it doesn't matter what I think. Just look at the raw numbers and look at the trend. And
here's another way to think about the Fed discussion. So instead of making it seem like a criticism, so if a government intervenes, they're taking some steps, they're taking some actions to do something where the markets might not otherwise go themselves. And they can do that for a long time, and they can push things and extend things like a rubber band. And you can conceptually think ahead 10 years and see how those rubber bands will get stretched and then break, and stretch and then break. And if you know that stretching and breaking is part of what we are going to face, what you're going to face in your lifetime, again, you just have to say, what type of strategy do I want to employ if that's the hand that we've been dealt? And what kind of return do I want to target? I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.